Hello and welcome to yet another edition of our special pre-election series, It's the Economy. In our maiden episode, we looked at the macros, GDP, inflation and the twin deficits. Today we look at how household savings and the financialization of savings performed in the past 5 years, that is in the 5 years of the BJP rule. Firstly, savings as a percentage of GDP has declined almost continuously over the past 7 years since the new GDP series and during the entire BJP rule. Within this, net household savings as a percentage of GDP has been very low and falling. This 6 to 7.4% compares with about 11 to 12% during the UPA era, but the two series are not comparable since the GDP base year has changed. Household savings as a share of GDP are falling also because household liabilities as a percentage of total savings has gone up in the past few years. That is, Indians are taking more loans. While it is good that Indian households, which have one of the lowest leverage in the world, are borrowing more, the negative impact is that less is available for investment. A bigger negative on savings and investment is the government dissaving due to fiscal deficit. While this has come down in the BJP years, the latest year has promised a large payout as farm income, which brings with it a threat of higher dissaving and leaves even less for investment. Finally, one big positive trend in the last 5 years is the rise in mutual fund investments. Tarun, thank you very much for joining me.
My pleasure, thank you.
Well, first up, let's discuss this very positive trend we saw post-demonetization. Actually, before that, from 14-15, this march of money into the mutual fund kitty. Do you think financialization of Indian savings has become mature?
So what I'm very pleased to see is that there's a movement of assets into the financial sector. It is certainly the case, and it's consistent with our report. We said that we'd like to see a movement away from tangible assets towards financial assets. We said that we saw very, very high rates of wealth being invested in both real estate and gold. And we would like to see a movement from real estate and gold into the financial assets such as mutual funds. This is certainly consistent with that kind of trend, and it's obviously very pleasing to see that there is a movement. But as with all things, there are a few caveats associated with this, of course. One thing I will say, even before the caveats, is that even though we've seen a vast movement of assets into mutual funds, if you look at the levels rather than the flows, so if I look at stocks rather than flows, we have a really long distance to travel in the sense that 90 to 95% of the wealth portfolio is sitting in tangible assets.
In real estate, basically.
Absolutely, pretty much.
Okay, so this is just a start of a trend. But although we did see this very good growth from probably 12 lakh crore to 23 lakh crore, this year in FY19 itself, year to date, the flow into fixed income has fallen by 1.35 lakh crore. Equity is still growing incrementally, but at a slower pace.
Right.
Do you think that that's okay? We can live with this fall, or do you think there are some red flags here?
So this is precisely, this is a great question, because this is precisely what the caveats are about.
Okay.
So I think before we declare that the financialization is complete and Indian household savings have matured, we need to think about the behavior of those household savings when they're in a financial market. So let me give you an example, which is that on the one hand, if you look at things as a financial economist would, standard theory would predict that you need to be investing at least some amount of your savings into an asset that has a positive risk premium like the equity market. However, the benefits of this kind of participation can be even destroyed or reversed if that participation is done inefficiently. So to put it differently, suppose you were to go in and chase after past returns, all evidence to the contrary. We have standard disclaimers on mutual funds that past performance is not necessarily a guide to future performance. If you were to invest in a very small number of stocks and under-diversify, then you can squander the benefits of participation by participating inefficiently. When I look at the recent volatility in the flows that you've talked about, which is in response to a sequence of negative returns in either the equity market or in terms of worries about credit ratings and uncertainty in the debt market, then I worry that what's actually happening is we have unrealistic expectations about the returns that are to be earned on financial assets, which then leads me to worry that this is a source of volatility and instability in household savings.
Okay. No, actually, we are analyzing the performance of the government. So, you know, would you say that demonetization as a policy helped in the financialization of savings? So, would you give credit to the government?
So, look, I mean, I think every policy has consequences. You know, whether I can directly connect the impacts of demonetization to the increase in financial savings, I'm not sure that I can establish a causal link between those two things, especially given, as you say, that from 2014, 2015, we've been seeing this trend even pre-demonetization.
But it jumped after 17.
Absolutely. So I think, you know, certainly we can assume that at least some part of the increase in financial savings may well have come from that source. Now, of course, the question is it permanent? Is it persistent? You know, have we achieved a structural shift? Or was it a temporary shift that with the vagaries of the market will then subsequently be reversed? I think all of this is yet to be determined.
The jury is out.
Absolutely.
Okay. But would you worry that actually savings can be badly hurt? Do you still believe the debt market could have an accident? What's your prognosis at the moment about this movement of household savings? What are the red flags? Are there any red flags?
So this is interesting. I think one of the things that we saw during the financial crisis in the US, certainly, was that there was a very dramatic episode, which is that the public's faith in money market mutual funds was broken because of the fact that, quote unquote, the buck was broken. Put differently, you know, for every dollar that was invested, there was always this expectation that you would get at least $1 or more for short-term investments, certainly in commercial paper and other such things. Yes. As soon as that didn't happen, there was a huge negative outflow out of money market mutual funds in the US. And this then contributed to the financial instability that you had then. Now, if you think that markets in India are in some sense, you know, equally behavioral in some sense, then if they don't understand the risk-return trade-off, this is then a source of serious risk in the economy.
There is a problem. Do you think that the last 5 years did not do enough to increase the total kitty of household savings? Household savings itself has fallen.
Interesting. So what we've seen is that household savings have fallen, but they've primarily fallen because of decreases in physical household savings in things like real estate. This we like, because obviously, as we said, we have sort of 90 to 95% of household wealth invested in real estate and in gold, and to see any sort of decline in savings rate in tangible assets is a good thing. That having been said, it doesn't look like overall household savings have risen. So clearly, you've had a decline in physical savings, but you've not had a corresponding increase in financial savings, which then leads us to ask the question, where has that money been going? And certainly, there is some evidence to suggest that consumption has been increasing, that debt has been increasing, personal debt for households. Now, just if I look at personal debt for households increasing, I can't immediately conclude that this is a bad thing, because one of the things that we document in our report is that Indian households seem to be, if you like, under-borrowing in certain areas and over-borrowing in others. Unsecured debt seems to be at fairly high rates. Secured debt, unfortunately, seems to be at very low rates relative to the amount of real estate that's on household portfolios. Now, if I'm looking at secured debt, I want to look at collateralized lending such as mortgages or home loans, essentially. But I don't think that's where we're seeing the evidence of the rises in debt. If that's where we were seeing the rises in debt, I think we'd be comfortable that we're seeing reductions in home equity on the balance sheet of Indian households. I think what we're seeing is a rise in personal loans.
Okay.
And then that causes us to worry that maybe we have a particular kind of debt that might then forecast instability in household balance sheets going forward.
Okay, that's a familiar problem in the West. Okay, but would you worry that household savings stagnating will actually be negative for growth? I mean, there won't be enough money for investment. Is this a long-range problem, or do you think it's short-term?
Okay, so this is a good question. I think our savings rates, even though they have come down, are still high in some sense relative to other comparable economies. And so I don't think that there's cause for concern quite yet. There are two red flags that are potentially on the horizon. One of them is if we get a debt-fueled consumption boom in households, then we've seen that there are problems, as we've seen in the West, where, as with rising household debt, there's been volumes written about this, that we might get then some instability. I think that's one potential source of issue. The other one is, of course, what are we doing with the savings that we've got? Are they being productively deployed? Are we seeing investments in the areas that are likely to yield the highest dividends going forward? This is another question that we need to ask, which is, are the investments being made in productive assets?
What's your answer to it?
So I think we are starting to see moves in areas that we need them. We need a social security net to be built. We need health spending. We need infrastructure spending. We need all of those kinds of spending. Those are indeed good things. The worry that one always has pre-election, and I think I said this the last time I was on this show, in fact, is that we must always worry about the fact that there are either promises that are being made that are unsustainable, that will need to be sort of upheld post-election, or there are pre-election spending booms that are happening in areas that are inefficient. Okay. Both of those are areas we need to watch out for.
Okay. Okay, one hopes that would be short-term problems. But investment itself has not really picked up. I mean, it's picked up compared to the previous 5 years. Would you worry that the investment trend is not as good as it ought to be?
So, I mean, I think gross fixed capital formation has been a continuing source of concern in the economy, especially given where we are as an economy. I mean, the state of our infrastructure requires enormous work. We still don't, we're not at the level that we need to be, whether it's hard infrastructure or soft infrastructure, and enormous investments are needed in those kinds of areas.
Okay. All right. Now, let me come to insurance. You spoke about mutual funds and you spoke about savings. What about insurance? Have there been any healthy trends in the past 5 years, especially the ones that the government has been pushing, like crop insurance?
So, this is a great question. I mean, I think, look, we've seen movements in health insurance, and I think certainly from the perspective of our report, anything that reduces the tendency of households to take emergency credit, certainly from the informal sector at very high rates, to finance emergency expenditure, anything that reduces that tendency is a good thing, because otherwise households get into debt traps, and then we worry about the consequences of those debt traps. This is true whether those risks are coming from the failure of the Rabi season, whether it's coming from crop insurance, whether it's coming from health insurance, from catastrophes, and so on and so forth. Now, there is a big problem here that is underlying all of this, which is you can go out there and put an insurance scheme in place, but in a sense, the insurance scheme is only as good as the claims process that you run.
And how is the claims process?
So I think there have been widespread complaints about the fact that the claims process hasn't been up to the mark. And I think this is basically symptomatic of an underlying structural weakness that we've always had, which is to say, how do we get systems that don't depend on leakage and inefficiency? How do we get systems that are, in some sense, actually leveraging the benefits of technology? Because suppose I have to get, sort of the bank representative plus an independent adjudicator to all come within 15 days and adjudicate the status of a claim. This is a really difficult thing to organize. And I think, any economy needs to worry about these kinds of things, especially one which is as complex as our own. And I think if there's a way to leverage technology to get us over the hump here, then I think some of these schemes will work brilliantly.
Thank you very much, Professor Raman Roy, for joining
Pleasure.
us. Well, that's the analysis of how savings and household savings and insurance performed in the past 5 years. So we will, of course, get more on the 5 years of the BJP rule.